Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Chuck Buller, Portfolio Manager with Nasdaq Dorsey, Wright, to discuss movement in asset class ranking as international equities continue to hold the top spot. Chuck, it's great to see you as always. Welcome back to Trade Talks.
Yeah, great to be here.
All right, U.S. equities, they continue to remain in a number 3 spot. What have you noticed there?
Yeah, so they're still at number 3. Now, this is out of 6, in our asset class rankings. A little bit surprising given, what we've seen in the banking sector. But, really hasn't changed any of our long-term rankings yet. We have seen commodities kind of move up. They're currently at the 4 spots. They've strengthened a bit, so they're kind of getting close to taking out U.S. equities at that number 3 spot. But they're not quite there yet. One interesting thing we have seen from this space, in the last month or so, is that the percentage of stocks in the S&P 500 that are in a positive trend on their point figure charts, we've seen that move below the 50% level. So that's given us some pause. That's typically not a great thing to see, as you might expect. The chart's currently at 44%. And, kind of seeing that along with, U.S. equities being at number 3, kind of below cash, which is at number 2. It increases the risks in the market. Typically, the worst things happen when that indicator is below 50, where we find it now. I think the upside, at least over the short term, is that some of our shorter term indicators, they're starting to get fairly oversold, which can indicate kind of a higher probability that we get a shorter term bounce in the market.
Yeah, I also thought it was interesting to see just how much the sectors had moved within a few months, from financials and energy kind of being the darlings coming out of 2022, technology not really, getting much love, but then the change, it was a lot of remarkable strength has moved back into technology. I think it was really fast in terms of that shift that you saw.
That's exactly right. So, obviously, financials are taking it on the chin. Here recently, they were ranked number 2 a month ago. Now they're down at number 7 out of 11 in our sector rankings. And energy continues its descent. It had been number 1, like you said, coming into the year. It was number 5 a month ago, and now it's down to number 8. If you look at something like oil is down like 15% this year. So that all kind of makes sense. Other names that, are still at the top, things like basic materials, industrials, consumer staples. But yeah, like you said, technology has seen a lot of strength this year. I think it's very interesting, if you kind of take the thesis that we're still in a bear market. And I think this is one of the things that, or at least one pieces of evidence to suggest that, maybe we aren't, because usually technology leads in a bull market. And we've, like IndX, for instance, is up, about 15% this year, not even including today. Beats every other index by a country mile. And in our rankings, we've seen, technology was probably, at or near the bottom, at the beginning of the year, and now it's at number 4 after coming up from number 7 a month ago. So it's definitely a lot of changes taking place. It'll be interesting to see how it all shakes out.
How about fixed income?
Yeah, so fixed income has been, interesting for the last, couple of years, as we've talked about before. Last year it obviously did not act like a hedge, right? It was down about as much as anybody's ever seen it down. And this year so far, it is acting more like a hedge. We've seen the aggregate bond index is up 3.1% year to date. But we've had huge rate volatility. It's the two-year yield index, for instance, had a 3-day move last week that was on par with its move back in the crash in 1987, which is just really unbelievable. And when you look at the move index, which is kind of like it's a volatility index of the bond market, it's at levels that we haven't seen since 2008. And so even though we're up for the year, it may not feel like the best ride. It's more like a roller coaster, over the last month or two. That being said, we're seeing yields falling, from where they were with the banking crisis. The 10-year yield is down to 3.4%, which is kind of marked the low the last few months. And I think it'll be interesting to see whether it can punch through that level this time. The one downside of that is that might not be good for the economy, right? If the rates continue to fall, it might be because people think the economy is weak. But so far, in our rankings, what we've seen in fixed income is high yield still at number one. Municipals are at number two. And we've also seen some pretty big changes in some of these groups here as well, with, as you'd imagine, something very equity sensitive like preferreds, convertibles. They've kind of gone coast from coast. In the last month, they were number two, and they've moved down to the bottom at number 8, given the crisis. And we've seen kind of long duration treasuries move up from the bottom to the kind of the halfway point at the number 4 spot. So again, this will be interesting to see how it plays out in the coming months as well.
Right. Appreciate the insight as always, Chuck. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.